Hey everyone, happy Tuesday. Special edition of Trade of Black podcast here today. Why? Well, we've entered into earnings season and it is going to be a busy week. First couple of companies that came out, some big notable names, Ascend Wellness and Chicago Atlantic. What were they? Well, we're going to dive into that today with TDR co-host Anthony Varell as we bring on John Hartmann, CEO of Ascend Wellness, along with Peter Sack from Chicago Atlantic. But Anthony, good to see you. Happy Tuesday.
Good to see you. It was a good day. Started off good. Like when earnings are out. Got stuff going on pre-market. Got a little of a sell-off going into the close, but I mean, it's volatility that everybody's already used to by now.
24 hours
shouldn't be too bad.
later. I know a lot of people.
Oh, you mean after the Sabbath tweet? Yeah. I mean, that's in one ear and out the other. Absolute no substance. It was completely debunked. And I mean, Ann Milgram basically came today and talked about the following comment period during her budget hearing on the Hill, which would imply that it's already been either approved or it's sitting at the OMB waiting to hit the register. So I'm going to trust Ann, go on my thesis that she didn't need to sign anything in the first place. Most likely would be the head of DOJ, which would be AG Garland. And then we can just take it from there.
Yeah, well, it's so many things to say. Who gave the information? Does this really happen? What's the significance of all this? Like, walk us through. Who did you speak to? If none of these names actually can be revealed on the record, then like we've always said in journalism, what's the quality of a piece of content or a tweet in this example that's like this? But that's for another day. We addressed that already. And today, like I said, it's the beginning of earnings season. And first company that actually announced their earnings earlier today was Ascend Wellness. So let's welcome in their CEO, John Hartmann, back to the podcast. John, good to see you. And how are things, sir?
Gentlemen, good to see you both. Thanks for having me.
Good to see you as well.
Good to see you. I'm going to highlight some of the stuff, but when I first glanced, looks like a strong quarter. Were you happy overall with what was basically announced to your investors earlier today?
We were very pleased, and more importantly, they were very pleased in our follow-up calls with them today. The feedback has been very positive.
Yeah, that's for sure. Well, let's highlight some of these numbers. Highlights included revenue that reached $142.4 million, which was over 24% increase year over year. Adjusted EBITDA grew to $32.5 million, which is up 39% year over year, with a margin expansion of 239 basis points. Gross profit grew to $52 million. With regards to retail and wholesale, retail increased over 15% year over year, and wholesale rose to $47.2 million. Big number to say the least. But when I look at that wholesale, what would you attribute such the big increase in numbers based on, when you look at year over year numbers?
Yes, I think your question, Shaz, about wholesale increase, I'd say just before I jump right into that, I'd say just broadly, the balance of the growth in the business is really appropriate. We've been trending around 2/3 retail and 1/3 wholesale across our 7 markets. Obviously, in the wholesale part of our business, more specifically in 3 of our 7 markets. But I think the real headline for us is that really nice blended growth across both the segments of our business. Specifically to your question on wholesale, look, it's 2 things really. It's having great product at a reasonable price and having a sales team that is out, working with individual dispensaries and working with our MSO partners to ensure that our products are part of their menus.
You actually took my first question the words right out of my mouth. It was actually as it relates to the mix of wholesale and retail. So that 2/3 to 1/3, is that the strategy, and are those the numbers that you kind of want to sit at? Or is there certain sway room in there to where it will align with, I guess, your overall objectives for the business?
Anthony, what we've said publicly is that for this year, that's the right mix for us. We're going to remain probably throughout the balance of this fiscal year, approximately 2/3 retail and 1/3 wholesale. It will change over time as we densify current markets. We may see more of our product going into our own dispensaries versus into our partner dispensaries. And then over time, as we enter new markets, that mix could also change.
Okay.
What markets would you say? Go ahead, Anthony. Sorry, I cut you off there.
I thought you were going to say something. Yeah, I mean, and then I wanted to kind of dive into Ohio. I think Ohio is going to be a big part of the narrative for a lot of companies on this earnings call and moving forward. We saw a lot of torque from Maryland, another market that you're in Q3, Q4 of last year. kind of thinking that lightning might strike twice with those numbers feeding into Q3 and Q4 this year as it relates to Ohio. I know you guys have the 5 locations with 3 potentially on the way. I mean, what's your take on Ohio? I mean, are you excited about it? Is it a market that you need to invest CapEx into from a cultivation perspective? How does it kind of sit within the overall business?
We're very excited about Ohio. We're excited that the state has moved up the launch of adult use. As we're all anticipating, sometime around the beginning of July, a little sooner, maybe a little later, depending on the exact timing. Very, very excited about the location of our 5 dispensaries in the state. Just having opened our 3rd, 4th, and 5th recently, and really the prospects as we saw just a year ago in Maryland. We planned for and anticipated like that 2 to 2.5 times adult medical use for adult use. That's really come true for us in Maryland, and we continue to leverage down the multiple in which we acquired that business right before adult use flip. We're equally excited about the prospects for Ohio and beyond with our 5 stores, and then as we believe the 3 additional licenses that the team's already working on sites for those licenses, and we'll have more to say about that in the near future. But we're very excited about Ohio.
Is there any specific market, that's really grabbing your attention right now, business-wise, versus say other markets that you're in here in the short term?
Well, first I tell you, that we love the 7 we're in. We continue to love our 7 markets. And what's interesting for us is that they're, and I promise I'll come back and answer your question. But I think what's interesting for us is that they're at various stages of maturity. So we've got young markets like Maryland. We're about to go. We've got a young market like even New Jersey from an adult use perspective, to markets that are just on the cusp of being born into adulthood like Ohio, and then we think probably not more than a year behind in Pennsylvania, another state we love. And then of course our big engines right now, Illinois, New Jersey, and Massachusetts are great markets, and of course we love our market in Michigan, and are potentially looking for ways to expand there. So, but your question was about other markets, and the answer is our company's approach to entering new markets is pretty obvious. It's been through acquisition. And we have a good, before my time, it's 1 year for me, but long before my time, the company's had a very clear focus on late stage medical markets and early stage adult use markets. And we're holding true to that. You're not seeing any big dramatic change in our strategy over the last year. So we what makes sense for us is continuing to densify the markets that we're in today, leveraging the assets and investments the company's already made. But in parallel, we are looking at a bunch of different markets that might make sense for us either in the near term or in the midterm. I don't know if naming states is what you want, but I'll tell you that, think about where we are geographically. We're not going to suddenly pop up, out on the West Coast. But, think about where we are. Think about contiguous markets. Maybe there's even a smaller population market where there's a small vertical with 1 or 2, 1, 2, 3, 4 dispensaries, which might make sense from a tuck-in perspective because it's contiguous to our current footprint, and we don't need to add any overhead or any additional corporate support. It can just fold into our structure. Maybe there's a couple of those we're taking a look at. There are larger states that are in the application process that we're keeping a close eye on. Then there's contiguous to Illinois is Missouri. We're doing our homework there, and of course you can't probably be in cannabis if you're not studying what's going on in the South and what the potential for additional states are in the southeast of our country at some point.
It's the next big wave, I think.
Do you see exploring Florida at a later date, pending the adult use initiative getting triggering, I guess, in November via the ballot? I mean, is Florida something that you would evaluate from an M&A perspective?
Yeah, I think, as I said, I think you'd be foolish if you're a acquisitive type company a great track record of integrating acquisitions and leveraging that capital deployment in an accretive way, then you of course you'd be looking at it. We're not in Florida today. We wish the best for our industry colleagues who are there, because it's an important state. I think will be an important signal. But it's a tough climb when you've got a governor who's outspoken against it. It's not helpful.
Yeah, it's going to be an uphill battle. I mean, we went over it yesterday. I mean, the Republican Party of Florida is officially against the ballot initiative in the state, so we'll definitely see where that goes. I mean, another state that you guys have in the portfolio that's considered a gem is PA. I know that it's from a corporate strategy perspective. I think the goal is to have 6 retail locations in the state by year's end. Is there any plans to go deeper and accelerate that strategy upwards towards the 18 cap in the state if they are to bring on adult use through some sort of accretive acquisition in that market?
Anthony, I won't talk specifically about what's in the pipeline beyond what we've said publicly, but you've done your homework, so I'm grateful for that. We just opened our 3rd store in the state. In a Pittsburgh suburb, and we've got 3 more coming over the next couple of quarters. And then look, we're constantly assessing additional opportunities in all of the 7 markets we're in, including Pennsylvania. We think we love what we're hearing from the governor's office in the state. We love that he feels that he's been left out of the tax benefit of cannabis. We look at it, in the reverse. We love that because he yearns for that taxes, we'll have, in addition to the patients we serve, we'll have customers to serve as well in the state. Yeah. So we're excited about the prospects of that for next year.
What do you think? Go ahead, Anthony. I was going to say Pennsylvania. What's kind of feedback? Like Governor, yes, is on board with that, but is there any next steps timeline wise? Like when you thinking adult use could potentially be presented to the actual passed, I should say, within the actual state? Like, what are you hearing lately?
I think we probably hear what everyone else hears, and sometimes it's accurate and sometimes it's not. Yeah. I think what we're hearing is that the governor would like to see regulatory action later this year, at the latest, very early next year. Yeah. And then based on timeline, from now to then, probably not less than 1 year. So our best read is perhaps at this point somewhere between July 1st-ish next year, middle of the year. But again, it's all very dependent on how quickly things move in the state.
Yeah, of course.
And my next question was around debt. I mean, I know you had opened up the call this morning talking about potentially refinancing the current debt and conversations around that. I know you have a piece of it is coming to maturity in 2025. I mean, what's the principle of that and the date of the maturity? And I mean, how are those conversations progressing? And have they catalyzed since we got the news about Schedule 3 last week at all?
I think what's really important with debt of this nature, just generally speaking, before we bring a son into the conversation, is just the credit worthiness of the company. And I think that the company has had a very strong track record of managing the business over the last several years. And I think that's the perspective that we entered into, just thinking about our refinancing. We started early purposefully. We started actually in general conversations last November with both our current consortium of lenders, and then more recently we had some broader general discussions with both current lenders and potential new lenders in the space. And I think that where the 2 critical things that our board has been assessing on the early stages of the refinances is basically the balance of timing. We want to go pretty quickly to get it behind us, even though it's not due until August of next year. Just to be clear, August of 2025. And to your question, it's $275 million. But also we didn't want to go too fast and lock ourselves into a potentially less advantageous set of terms. And now that rescheduling is here, I think all the cards are on the table. And as we said in our public earnings call today, it's our intention to have the refinance done before it becomes current, which would be 1 year before it's due. So before mid to end of August this year, we fully anticipate having the entire package redone.
Okay.
Well,
I know a big part of the narrative is doing away with 280E, and a lot of people just say, well, 280 is going to drop to the bottom line, and everybody's going to be all for the better. I mean, I think it's a lot more complex than that. As far as the conversation goes, I mean, have you started like strategically planning within the organization from a capital deployment perspective where that capital would go? Or is it kind of let's have that conversation and deploy that strategy once we have concrete guidance on 280 actually going away versus Schedule 3 reform?
Well, we took a bit of a proactive stance with our tax strategy last year. And we stopped paying 280E taxes. So, and we are currently paying our federal non-280E taxes on a go-forward basis, on a quarterly estimated basis, just like any normal federally taxed corporation. We've said this publicly before. We've applied for a refund at both the federal level and the state level for the 280E taxes we've paid over the last several years. So we are anticipating hearing back from the tax authorities on our amended returns in the near future. And when that happens, we would be the beneficiary. If and when that happens, we would be the beneficiary of a one-time benefit from those refunds, which would be substantial. But our current cash flow projections, our current utilization of capital reflects our go-forward non-280E paying strategy.
Yeah.
Okay.
Are there any ramifications at all, just to understand, like if you're not paying 280E now? Like I understand you've applied, but what are you anticipating as far as feedback? Obviously, you're probably hoping for something positive, but is there any ramifications whatsoever?
Well, again, just to be crystal clear, we've done this with very clear, incredible tax guidance from outside legal authorities. This hasn't been something that we just came up with on our own. So this is a well thought out strategy that's been considered by our company and then implemented. So what are the ramifications? The ramifications are the taxing authorities could have a different view than we have.
Gotcha. Makes sense. Well, listen, I know. Go ahead, Anthony.
I was going to say my last question was in regards to guidance, which is much appreciated. I know that you guys guided for net revenue up 11% on the low range, 13% on the high range, and then adjusted EBITDA guide was 15% on the low range and 18% on the high range. What do you see attributing most to that EBITDA boost? I mean, that's a healthy guide up.
Actually, I'm not sure what numbers you're looking at, but let me just, sorry to correct you here live, but our actual revenue guide is 12 to 15% up.
Okay.
And our adjusted EBITDA is 17 to 22% increase.
I need to check those numbers, but yes.
Yeah. So what I think those revenue and EBITDA numbers actually, we feel very comfortable with that range. That range does not include the adult use go live in Ohio. So that would actually be further upside to that guidance because we didn't know exactly when Ohio was going to happen. So we were cautious and conservative not to include that in the guidance. But yeah, we're excited about the prospects and the outlook for the balance of the year. It is based on exactly what you guys opened up with your first question, and it's that nice balance of retail growth and wholesale growth, kind of complementing one another in these 7 markets that we're operating.
And I know what I did on those numbers. I divided the EBITDA by the current revenue, not the projected revenue.
Gotcha.
So, yeah.
Before I let you
That was an
go,
easy mistake.
what'd you think of the news last week? It was encouraging, right?
Very, very encouraging. I mean, we're just, it's great when common sense prevails. So
Yeah, no kidding, right? That's putting it
obviously,
like it is.
Yeah.
yeah, it's just, it's a great step. You know, we collectively feel that it's a well-informed step. We, you know, as others and others that have been in the industry far longer than I have, we hope it's the first of many dominoes that would, you know, logically fall into place in the near term.
Yeah. Well, as I said a couple of weeks ago at Benzenga, the sentiment of the overall industry seemed a lot more positive than the previous 12 months. But, you know, hopefully that momentum can continue. And like I said, we get a ruling before the election, and let's, you know, measure 3, you know, there's a lot of ifs involved there, but in Florida, that would be beneficial. But then pure fundamentals, you know, expansion, and like, you know, you have a big background in executing. And that's probably what the stage we're at within this industry. And it's just, if we get some consistency involved in the industry along with some legislation that moves, then you can understand where this industry could rapidly grow over these next 6 months. But we got our fingers crossed, right?
Yeah, we do. We sure do in toes.
Yeah, exactly. Yeah. Good point. Listen, great catching up with you. Let's keep in touch, and congrats on the strong quarter earnings, which was announced earlier today.
Gentlemen, thank you for having me. Appreciate the time, and have a great afternoon.
Yeah, you too. Thanks, John.
Thanks, John. Man knows how to execute, has a wealth of knowledge and experience doing that. That's for sure. Hello, Emily.
They've got a hell of a footprint. I mean, they've got a lot of states that there's a lot to like. I mean, especially with Ohio, with PA, lot to like in that footprint.
So Michigan, Illinois, Pennsylvania, Ohio, Maryland,
Massachusetts.
Wow, they are in some good markets.
They're in the best. They're in the best markets you could be in that corridor.
I like how he explained, like, look, some of these new states that come to market, they get a lot of the attention, but it all depends on what size or what, you know, as far as maturity, where you are at certain stages, but they're all important, which probably is a pretty accurate question. But anytime a new state comes on, it's obviously going to grab a lot of attention. But listen, we're keeping our earnings season going along, as we're probably going to have about 10 companies on here today. So here's number 2. Let's welcome in one of the biggest debt lending companies in the country. Let's welcome in the co-CEO of Chicago Atlantic. First time to the podcast, Peter Sack. Good to see you, sir. How are things?
Wonderful. Thanks for having me.
Yeah, appreciate it. And first off, you know, as I said, I always like to get some feedback. You've been in this space for quite a long time. You work your company with a lot of MSOs within the overall industry, but you were down at Benzenga a couple of weeks ago, and to our viewers out there, like, again, what are you seeing here in 2024 as we build more and more momentum pertaining to the industry, and even more importantly, just some of the news that we experienced last week?
Seeing a lot of strategic optimism. Even before rescheduling announcement, just a renewed optimism in terms of, in the face of depressed equity valuations, recognizing that we still have to grow. We still have to find the next opportunity. We still have to expand. And the operators sort of getting back on the road and meeting potential merger opportunities, thinking about the next cultivation build out, the next dispensary build out. I think that's just a sense of optimism that I don't think was really there in 2023
at all. You know, when I think about where we were in the spring of 2023, it rained 36 inches in 3 days, and it was kind of like the nature of the industry at that given time. But fast forward 12 months later, and I think that, like I said, there's a lot of optimism. But look, let's first report your latest earnings. You reported net income of $8.73 million, generated $15.34 million in interest income. Total assets increased to $383.65 million, up from $359 million at the end of 2023. So again, I'll ask that question when it comes to total assets and how that increased. To your point, like, you must be seeing just the growth of the overall industry. Like, what's pertaining, or what's the key factor in what you're seeing as far as the growth opportunities that you report in your latest earnings?
Yeah, we focus on doing the same thing that we've been doing since our inception nearly 6 years ago, and that's in a volatile, emerging industry, creating an investment product that is attributes principal protection and attractive, reliable yield, while funding growth of some of the best operators across the country. And so when we think about asset growth and investment growth, it's always with a constant thought to the opportunity set and the ability to deploy, and both raising capital at attractive cost of capital and deploying it into attractive opportunities. So over the course of this year, we expanded our credit facility.
Yep.
We were the largest credit facilities backing a portfolio of cannabis loans. It's made up of a large syndicate of FDIC-insured banks. And we raised a smaller amount of equity at an attractive valuation at a couple points over the course of the year.
Were a couple of those raises through the ATM?
Yep.
That was accretive capital actually coming into the firm. I
Yep.
mean, you've got, I think, 401 million in total assets over 28 investments throughout the sector. I mean, one thing that we don't talk about, or I'd love to get your perspective on, are the private businesses or the private investments, that private deals that you're seeing, are they stronger by any means from a credit standpoint than the publicly traded businesses? Or, I mean, how are you looking at that when underwriting?
And we've lent to a number of the top 20 MSOs, and it's public that we're lenders to Verano, lenders to TerraSend, lenders to Schwaz. We've been bondholders in TrueLeave. I think you can get great risk reward in both areas. The vast majority of our lending, though, has been to one level below the public MSOs, the single state or 2 or 3 state private operators that are looking for growth capital.
From an investment thesis perspective, I mean, a lot of people are expecting safe banking, Schedule III to bring. I mean, you are institutional capital. They're speculating that this is going to bring traditional institutional capital off of the sidelines. I mean, are you guys seeing that? Are you getting courted by any of the larger institutions due to the expertise in the space, and them coming to you and trying to figure out how to strategize capital deployment within the cannabis industry?
Yeah, I think we're consistently speaking to people outside of traditional cannabis finance markets.
Yeah,
That's where my background lies and where my partner's background lies. And there's a constant expression of curiosity. On the back of rescheduling, we've not seen a noticeable change in outlook. One, because I think the timeline for the actual implementation of rescheduling is quite uncertain.
Yeah.
And two, even if rescheduling were to occur tomorrow, it unfortunately leaves a lot of questions unanswered still.
Yeah.
Schedule III drug is still regulatorily ambiguous. The availability of bankruptcy courts is ambiguous. The treatment of interstate commerce is ambiguous. And so unfortunately, that means that a lot of the traditional finance hasn't entered the market yet. We'd be very excited for it because it would mean a lot cheaper capital for us as well.
Yeah.
We built a bank. Our firm is still close to 0.33 times debt to equity. It's very under-levered for a mortgage REIT relative to the broader market. And rescheduling access to broader capital markets would give us ability to have back leverage on par with other funds of our size and our diversification.
And then I know in your prepared remarks, not your prepared remarks, but in your comments on the press release, you had mentioned Missouri, Ohio, and Maryland as being markets of interest, and exciting markets. I mean, Missouri is one market that's very underexposed from a publicly traded MSO perspective. I think it's a misunderstood market. I mean, what does excite that market out of you? I've heard several conversations that I've had with investors saying that's actually very good. There's very good economics in Missouri if you are to go deep in it. So I mean, I'd love to hear your point of view on that market and why that one was actually mentioned.
Yeah, I think there was a fair amount of discipline in terms of the number of licenses that were issued, particularly on the retail side, that's created healthy but not excessive competition. And then there is, I think, because the MSOs have not entered the market, I suspect because of residency requirements that were particularly important during the medical period, it meant that in Missouri there's an ecosystem of very strong, sophisticated operators that grew to scale and cut their teeth during the medical market and are now reaping the benefits of that in the adult use market.
Okay. Do you see Missouri as kind of ripe for consolidation, or where MSOs are kind of going to go to for bolt-on acquisitions that could be accretive into the future? Because I mean, we're seeing a lot of them, for instance, pile into Maryland, pile into Ohio, Virginia. Some of them are there. Pennsylvania, Missouri kind of seems ripe for the taking if you're looking for an accretive asset to bolt on to the overall enterprise from an MSO perspective.
Yeah, I think that's right. I think the existing operators within Missouri have already begun consolidating the market.
Okay.
I think one of the reasons we haven't seen many MSOs in Missouri yet is simply because of the strength of the existing operators.
Okay.
That they are in a position to set the terms under which they become acquired or under which they expand, and they've had a lot of success growing organically over the last 3 years, and in ways that some other nascent markets were more capital starved and therefore more willing to be acquired or merge early.
Yeah.
Okay. And then I mean, Florida is a hype. I mean, as far as I'm down in South Florida, so I mean, I consider Florida like a hyper competitive state, super high barrier to entry. I mean, do you see Florida as an investable state right now, or an investable market as it stands today, or more so on the backs of, let's say, adult use passes, there's some consolidation, taking more of like a wait and see conservative approach to capital deployment in a market like this?
Mm-hmm. So we were an early entry into Florida. Across our platform, we deployed probably close to $100 million into Florida operators.
Okay.
Since our inception. And it's an extremely attractive market for existing operators, very difficult for new operators until adult use passes. The barriers to entry from a licensing perspective are high, but it's the capital costs to build a profitable organization are very, very high. So we're extremely enthusiastic about the prospect for adult use in Florida. I think it's going to be a phenomenal market. Until that passes, though, the barriers to entry are, as you said, quite high.
Yeah. Peter, what do you think are the biggest trends that you can see grow? Like in the event we get a ruling of rescheduling prior to the election or in the next 6 months, like how are you guys preparing yourselves for something like that? Like what are some of the biggest trends that we see with the overall growth of the industry that you're paying attention to? Yeah,
I mean, I think your last guest, John from Ascend, took the words out of my mouth. We're very excited about prospects in the South. Besides Florida, we're excited about nascent markets in Georgia, Alabama, Mississippi. And then we like the rumblings that we hear about Virginia. So I think until there's more...
is that the next big wave, like the Mississippi, Alabamas, and Georgias that you're seeing within the industry? Like we talked a lot about like Ohio, we talk about Pennsylvania and states like that, but is that the next big wave as far as growth states here in the country?
I think it's still early, but yeah, those are on the rise. I'd add Pennsylvania to that list, but Alabama, Mississippi, Georgia already have medical markets, but they're in different stages of development. But I would add Pennsylvania to that list too. But until rescheduling becomes more definitive, I think this continues to be a narrative about state-by-state developments, which there's still a lot of positive catalysts for the industry.
Yeah. Well, one of the things I've learned, I know with you being one of the biggest debt lending companies in the overall industry, the biggest misconception I think a lot of viewers get is that once actually safe banking were to pass, it's just like traditional banks would come in and where's the value of dealing with somebody like yourselves? And I'm always like, well, best of luck with these traditional banks that really understand how to explain how underwriting works and following this industry in and out. So they actually are going to lean on a lot of expertise in firms like yourselves. And when that does come, maybe explain to our viewers a little bit more on what that opportunity presents for you, your firm, and for a lot of companies in the space that operate in the same capacity as you.
Yeah. Well, I think for one, it's going similar to the story around descheduling. It is going to lead to significant growth in equity value across the industry.
Yeah.
Significant new equity dollars coming into the industry. And for us, that means more projects to finance, more growth to finance, and better credit quality among borrowers. So it's going to create a huge new source of demand for debt capital and safer debt capital.
Yeah.
Capital markets have changed over the last 20 years, and traditional banks are a much smaller portion of the broader lending market than they were before the great financial crisis. And private credit firms, of which Chicago Atlantic is one, have taken up a much larger piece of traditional middle market lending. And so I don't think banks replace private credit in the cannabis industry, because banks haven't replaced private credit in any other industry. And I think the products are different, that banks are much more traditional in terms of the types of collateral and assets that they're backing. And there will be a place for banks, and there will be a place for private credit. And we look forward to, we're hopeful that something like safe banking will also open up opportunities for us to lower our cost of capital, increase availability of debt and equity.
Well, like John said, we got our fingers and our toes crossed for that day, right?
Absolutely. But in the meantime, continue to originate and build relationships with some of the best operators in the country. And create a portfolio of extremely well downside protected first lien real estate backed debt that generates strong returns that, even on a very underlevered basis, compares well with mortgage REITs and yield vehicles across the cannabis and non-cannabis market.
Are you exploring deploying capital abroad, like as the European market progresses, as the Australian market progresses, or is it just, as far as the mandates go, is capital deployment pretty much tied to the U.S. For now?
The mandate could expand, but we're really focused on the U.S. I think we have the market opportunity here is still so strong that I think it would be a wrong allocation of time and resources when there's so much to do here.
Yeah. Well, I got to hand it to your firm. That was about a year and a half ago. I was down at MJ Biz at the one of the investor conferences, and I think you guys flew the entire company out to Vegas just to learn more about the space. There was about 60 of you in the crowd, but I don't know whether it was you or was it John that was actually on stage that was speaking that day, but it was a good panel just to talk about lending and some of the trends that we can forecast over the next 12 to 24 months. But to your point, big opportunity in your space, and I know that you're working with a lot of the bigger MSOs within the country, but congrats obviously on the latest earnings, and most importantly, let's keep in touch, and hopefully we get some news in the next few months that can grow and expand the overall industry, right?
Absolutely. Fingers crossed.
Yeah. Peter, appreciate your time.
Thank you, Peter.
Bye.
All right. So there's our first two in the books. But for those viewers that are at home, like Chicago Atlantic is probably one of the most well-known names and conversations when we're at these conferences.
I was surprised by a couple of the comments saying that they've never heard of the company. I mean, if you're not aware of the company, I mean, they trade on the NASDAQ under the symbol REFI. They've got one of the stronger portfolios in the space. And they've been around for a very long time. I mean, you want to talk institutional capital? I mean, they're true institutional capital from a private credit perspective in the cannabis space. So, I mean, it's definitely a company that I would recommend reading up on and getting acquainted with.
Especially in the event you get the safe banking to pass. That's going to open up a lot of doors. Before we go, I think that before we're approaching the 40-minute mark, was there anything you wanted to touch on pertaining to Canopy in the news today?
There's an announcement today. Wana and Jetty went final. They finalized picking up the options on both companies. It's good to see 2 of the 3 assets get knocked down. I mean, I know that we talked about this with David Klein in our last interview. He said that the third piece of the equation, or acreage, was going to be the hardest one, as it's publicly traded. I'm sure that in our follow-up interview with David after earnings on the 30th of this month, we'll go over the assets that are being amalgamated into that CUSA vehicle. And he'll have color pertaining to what the process is going to look like on a go-forward basis.
So the 30th or this month or next month for earnings?
30th of this month. Canopy's earnings come out.
Okay. All right. So now tomorrow we've got George Arcos, Aaron Miles on from Verano.
We do. We have Verano on tomorrow afternoon.
Who else will be reporting on the show tomorrow so I can quickly top line for everybody here?
Tomorrow, I think as of right now, it's just Verano.
Is it Verano?
It's Verano, and then Thursday, it's Wednesday already.
I know.
And then on Thursday, we have Anthony Coniglio from New Lake, as well as Zach George, everybody's favorite guest from SNDL. And then Friday, we have Ziad, CEO of TerraSend.
Green Thumb. Wucifer writes, Green Thumb.
If you can get Ben Kovler, I will send you 5 hoodies.
Yeah,
from the TDR from the TDR cachet.
We try.
I mean, I would love to talk to Ben. I respect Ben. Ben's been in this for a very long time. He's one of the more colorful CEOs, but Ben does not like doing press. I've reached out to him, tweeted at him, DM'd him, emailed him, smoke signals. He just hasn't answered.
Green Thumb reports their earnings tomorrow, though, correct?
GTI do report tomorrow. So we'll do if tomorrow the only guest is Veranos, we'll be going over earnings with George and Aaron. I'm sure we'll be talking about the other earnings that are tomorrow as well, which to my knowledge is Village Farms, Verano, and Green Thumb. Green Thumb comes out after market, though, and this says that they're out at 5 p.m. Okay. So we might be off stream by the time GTI drops. So GTI will get covered on Thursday in a incremental segment.
And a quick reminder, last Friday, Dan the Chartman was on. And yes, we were talking about markets, and obviously everything's kind of like turned for the worst. Not the worst, but, in the red, obviously, in the first 2 trading days this week. But one thing that he said pay attention to was the SNDL chart, and it is performing better than most within the space right now. And I know there's a few comments here today, but that and obviously the latest earnings and more with Zach George on Thursday for 4 o'clock. Yeah. So I'm sure you SNDL investors will be happy for me to outline that, and as well the upcoming interview later this week.
I'm pumped to talk to Zach.
Yeah,
we got a lot to go over. We've got a lot to talk about the Sunstream implications, a lot about the asset mixture within Sunstream via the parallel assets, via Skymint.
Yeah.
A lot to talk about with Zach on Thursday.
DOS, MaryMed does report tomorrow. We're actually doing a pre-recorded interview with their CEO, John Levine, on Thursday at noon. We're going to post that first thing Friday morning, probably around 8 a.m. That's 3 hours before our Friday morning live stream. And again, Friday morning live stream, we're having Ziad, CEO of TerraSend on. So lots to go, but we got the first 2 out of the way. Hello to Emily Paxia, if you're still watching as well. Thank you for the kind comments. Kicking off our earnings season with the great company with Ascend Wellness, followed by Chicago Atlantic. And Peter Sack, very nice of him to log on. I see him in the background. I think he's got his kids hanging out there, but he's got a big smile on his face. Give a wave there, buddy. There you go. Oh, looks like a new baby. You guys can't see, but that's awesome. Anyway, we all appreciate it as usual. Click some likes, leave some comments. Let us know if there's any specific companies or questions that you want to know or learn throughout this week. Please let us know. As usual, log on to the Baked In newsletter. We have a deep dive at every single earnings and the key takeaways from each company's earnings in our newsletter, all outlined by our head of research and lead financial writer, Bill McLarland. So appreciate it if you guys could subscribe to that Baked In newsletter. I'll put the link. Actually, Arns, if you can bring up that QR code, have some people just scan that real quick and log on. And as usual, we will very much appreciate that. In the meantime, enjoy the rest of your afternoon, and we'll check back in tomorrow at 4 o'clock with Aaron, George, and then have a quick run through of some of the other companies that Anthony just outlined. Take care, everybody, and we'll see you tomorrow.
Bye.
Hey, everyone. Thanks for watching our latest podcast. Lots of momentum building. You guys getting all excited? Leave comments below. Again, we want to take this viral. Smash that like button and make sure to click on that bell for all notifications as we start to bring on bigger and bigger guests. Don't forget to subscribe to our daily newsletter, the Baked In newsletter, by logging on to thedalesreport.com. And we want to take this viral, as I said, and make this community grow. So make sure to subscribe on that channel because we wouldn't be here without you. Thanks again, everyone, for watching.